All right. So, hi everyone, welcome. We're doing a mortgage Q&A and we have Mark Casamassina here from NJ Lenders. He is one of our partners. So, I just want to welcome you and also just a quick background. So, Mark, how are you? Welcome. Thank you for joining.
Thank you, honey. How's everything?
Good on my end. How about you?
Good. So guys, I'm Mark with NJ Lenders. I've been doing this for 27 years. I'm actually a partner here at NJ Lenders Corp as well. I have 6 children, and I'm here to help you guys whatever you need. So we set up a question and answer type setting. Christine has some questions for me, and maybe you guys have some questions as well. We can just kind of roll from there and try to educate you guys a little bit on the mortgage side of things. So Christine, it's up to you.
Yeah, so I know that one of the questions that we had come in or that someone was talking about previously was when it comes to a home inspection and there's negotiations with credit. So what are some ways in which they can handle that?
So once the home inspection's in, guys, and the attorneys and you negotiated a credit, number one, the most important thing is to make sure that credit won't affect the mortgage that the clients are applying for. So in other words, let's just say you have a $400,000 purchase price and they negotiate a $10,000 credit. Well, the first thing I'm going to tell you, if it's a credit for repairs and you send an addendum to me as the lender and you tell me it's for repairs, we would have to ask you to fix those repairs, because if there's something wrong with the house, obviously we want to fix prior to closing. So the way around that is that the attorneys we're going to ask the attorneys to reword that credit to where it's a credit for closing fees. So what we have to just make sure is that $10,000 credit is acceptable to the lender, because in some cases there's maximums to the amount of credit somebody can get. So, and it's based on the percentage of the purchase price. And on top of that, if you had a credit already negotiated into the transaction, so in other words, you had a $400,000 contract price and there already was a $10,000 credit for closing fees from the seller to the buyer, well, now you have a total of $20,000, and that credit for closing fees can't exceed the cost of the closing fees the day of closing. So in other words, if the closing fees are $12,000 a day of closing and you had a total of a $20,000 credit, the seller would keep the difference, the $8,000, so that the buyer would get their $12,000 credit for closing fees, but the seller would get the other $8,000. So it's always important that when that's negotiated is that you consult your lender, make sure that it's acceptable. And then once everybody agrees to what that credit is for closing fees, make sure you get a copy of that addendum to the lender, because a lot of times we find out the day of the closing that there's a credit for closing fees, and we have to change the paperwork a little bit. So it's a little bit of back and forth at the end, which causes delays.
Right. I know another question that came in. Some people are a little confused about the pre-approval versus pre-qualification. So can you just go into more detail about that?
Yeah. So guys, there's a term called pre-qualified, and then there's a term called pre-approved. A pre-qualification is basically a simple conversation that myself as a lender is having with your client when they're getting ready to purchase a home. So all we're doing is talking about, hey, how's your credit? My credit's good. What's your income? It's about 100,000. How much you putting down? Maybe 10%, but nothing's verified. So it's just a conversation. So if you see pre-qualified on a letter coming to you with an offer on it, my advice to you is to reach out to the lender that did that pre-qualification and make sure that they verified the person's income and assets, which then would make it a pre-approval. So what I mean by that is when we pre-approve somebody, I'm reviewing your client's pay stubs, tax returns, pay stubs, and W-2s. And I'm also going over the assets with them to make sure, is the money their own? Is the money a gift? Is the money in the bank now? Some people have money in the mattress, which is no good. Cash money is no good. We run their credit, we review the debts with them, and we make sure that they're qualified, where they're legitimately approved to get that mortgage, where the only thing it's technically subject to is the house appraising.
Okay, before I go into any more questions, does anyone on the call have any questions that has come to mind so far that Mark's gone over? Anything that you need explained in more detail?
I actually do, if you don't mind, Mark.
Go ahead.
Back to the first question, in terms of a credit to the buyer, I guess it'll be, right? At the closing, that way it can't exceed the amount of closing costs.
Mm-hmm.
Does that apply to all loans, or is that just specifically geared towards like a conventional? Like, would that apply to, like, let's say a VA loan or FHA, or anything like that along those lines? Could you just tell us like the
Yeah,
differences between the three?
good question, Abel. It applies to everything. It applies to a FHA loan, a VA loan, or a conventional loan. Anytime there's a lender credit negotiated or a seller credit, in this case, negotiated, it can't exceed the closing fees. Anything above and beyond that is technically money that the seller gets to keep. And if it was handled outside of closing, in other words, they agree, well, we agreed to give this to you, so the seller writes the buyer a check. Technically, that's no good. You know what I mean? That's I guess I would say that's considered illegal.
Okay, I'm only asking because I mean, again, I'm new in the business, so but I've heard with like VA loans where the buyer sometimes walks away with
well, the
check,
buyer,
I guess.
yeah, the buyer could walk away with money there because in that situation, Abel, with a VA loan, especially, most of the time you're going to see a VA loan with no money down. But as a seller, they may be looking for a good faith deposit up front. So the person gives a deposit up front, but then the day of closing, they get their deposit back because they got their financing for 100% of the purchase price, and they might have financed their closing fees as well.
I see. Thank you.
Okay.
So actually, Mark, Abel was one of the agents who emailed me and asked about a VA loan. So he asked, VA loans specifically, how do they relate to buyer agents and possible credits to the buyer? And also, what's the likelihood of a VA or an FHA winning the property?
All right. Well, first I'll tell you that's a question for your broker regarding FHA to VA and winning the property. I'll talk to you about my experiences, Abel. So what I'll say to you is my experience has been in communicating with realtors when offers are made. When it's a FHA contract and it's a multiple bid situation, the listing agent tends to take the strongest offer. So, and the strongest offer is sometimes with more money down than an FHA or VA buyer, because a lot of times those buyers have zero money down. Now, it doesn't mean that everybody going for a VA mortgage or an FHA mortgage goes with the maximum financing. I originated a VA purchase mortgage yesterday morning, and the client was going VA, but they were putting down $150,000. And the reason why we went VA is because they were able to get a more favorable interest rate than they could have got going with a conventional mortgage, even though they were putting down $150,000. But the fear that a seller has when they see a VA buyer or an FHA buyer with 3.5% down in today's competitive market, where everything is highest and best, is they're concerned that the house isn't going to appraise. So if the house doesn't appraise, now there's not a lot of wiggle room for that person to make up the financing when they're trying to purchase the house. In other words, if somebody puts on 20% and the house doesn't appraise, they still can obtain financing in some way, shape, or form because they have 20% to work with as far as the down payment. But when somebody's putting down zero money and the house doesn't appraise, now it's up to the seller to reduce the purchase price or that buyer to come up with money when originally they were coming up with zero money down. Did that answer your question?
Yeah, I think my main, thought process behind that was that I know that in order to, it has to appraise. It's basically the appraisal was my main thought behind that question. And I know that if it doesn't appraise, then I guess if the deal, so to speak, falls through, that the next buyer or whatever, the appraisal kind of stays with that property if it's FHA,
If it's recorded, yes.
Yeah,
Yes.
they just use the previous FHA. Okay, that's kind of what I was just trying to get clarification on. Thank you.
You're welcome.
Okay, Mark. So speaking of appraisals, one of like our MCA, she asked about appraisal requirements and how to handle when an under sales price comes for the appraised value.
Okay, so guys, when a house under appraises, there's a couple different ways from the lending side of things to help somebody with the financing. So I'll use numbers. Somebody's buying a house for $400,000. They're putting down 20%. So now they're financing $320,000. But now the appraisal comes in at $380,000. Well, that just affected the financing because as a lender, we as lenders, all lenders in New Jersey, it's the appraised value or sales price, whichever is lower. So if the appraised value is less than the sales price, then that's what we have to base our loan to value off of. So when I said earlier, $400,000 purchase price to a $320,000 mortgage, that's an 80% loan to value. But the minute you get a 380 appraisal in that situation, if the borrower agrees to still pay the seller $400,000 because the seller doesn't want to adjust their price, in my eyes, the lender's eyes, it's an 85% loan to value, which is still workable. The client would either pay private mortgage insurance, PMI, which with an 85% loan to value, they'd pay it for about 3 or 4 years. So it's not a major thing. Or we can do something that's called borrower finance PMI, where we just say to them, hey, look it, you're going to finance a few $1,000s more, roll onto your loan amount, but you're not going to pay the monthly PMI. So from a lending point of view, it's with money down, it's easy to work out. The challenge that happens sometimes that people lose sight of is they're putting down 20%, so it doesn't matter if the house doesn't appraise. Believe it or not, that person that's putting down 20% was putting down 20% because they didn't want to pay what's called private mortgage insurance. So I'm almost of the opinion, and only my opinion, that if somebody's putting down less than 20% and the house doesn't appraise, they're not sticker shocked by that they have to pay PMI now, because they're already agreeing to pay PMI. Just the cost of it may go up a little bit. PMI has a stigma that people don't want to pay PMI, but it's not the end of the world. They just pay it for a few years. And there are alternatives out there to do what's called borrower finance PMI, where they buy it out by financing a few extra dollars. They buy it out right at the closing, so they don't have to pay it. But to go back to your original question, how do you deal with it? Well, if from the lending side, that's how I would deal with it. But from your side, you guys might want to renegotiate the contract with the other side. We provide the appraisal. I know at NJ Lenders, if a house under appraises, we work very hard to appeal the process to see if we can get that value up a little bit before we go and alarm everybody that the house didn't appraise. Because sometimes what you find with an appraisal is the appraiser maybe miscounted the bedrooms, miscounted the bathrooms, maybe the square footage was off a little bit. So we always go back and revisit that before we alarm everybody that there might be a situation where the appraisal came in under. Was that good, guys? Did that answer your question regarding that?
What's the difference between a PMI and an MIP?
MIP is what's referred to as a mortgage insurance premium. So that's with an FHA loan. So
Yes.
with an FHA loan, you pay an upfront mortgage insurance premium, which is 1 3/4% of the loan amount. And you also pay a monthly mortgage insurance premium, and in most cases for the life of the loan. So with less than 10% down with an FHA loan, you pay PMI, monthly PMI for the life of the loan, unless you refinance out of that. Whereas PMI is more associated with a conventional loan, what stands for private mortgage insurance. And the purpose of the private mortgage insurance is because the government guarantees or insures us as a lender up to 80% of the purchase price. Or value. So if somebody is, again, paying $400,000 and borrowing $320, no PMI is necessary. But if they were borrowing $360, now they have a 90% loan to value. So as a lender, any lender, the government's guaranteeing us that we'll get repaid our money if that person goes in default up to a $320,000 limit. So now in order for Fannie Mae or Freddie Mac, the government, to back the lender is going to need the borrower to pay private mortgage insurance to make up the difference between the 320 and the 360 in the event that that client ever went in default on their loan.
Okay.
Okay.
So does anyone else have any questions right now before we move on? Okay, so Mark, I know that you wanted to touch on sellers concessions.
Yes. So 1 sec, guys.
Gotta get some water in.
Yeah, I gotta get some water in. So guys, with a seller concession, there's some rules with seller concessions that a lot of times I get asked a question, how do I write up the contract for a seller concession? What do I do? How do I present the offer? I have found it best that when you're presenting the offer, you should write in the seller concession. And a seller concession, the percentage of the seller concession is based on the amount of money somebody's putting down. So what I mean by that is, if it's an investment property and you're buying an investment property, the maximum seller concession can be 2% of the purchase price. So again, I'll use the $400,000 level. You're buying a house from me and you offer me $400,000, but you want me to pay $8,000 of your closing fees. What that means net to me as the seller is I would be getting $392,000 because you offered me 400, but you're asking me to pay $8,000 of the closing fees for you. So that's net to me 392. So my response back to you is no. I want to walk away with 400,000. So how do you structure the contract? You have to present your offer where it's going to be a 408 purchase price with that $8,000 concession built into the 408, so that at the closing, it's technically the seller, me, giving you a credit back at the closing of $8,000 to pay your closing fees. And then the purchase price would be 408, not 400. And then your down payment would be based off of 408, and you would borrow a few dollars more so that at the closing, I technically get that extra money that I give right back to you at the closing. So with an investment property, the maximum seller concession is 2% of the purchase price. For conventional loans with 3 to 5% down, or really 3 to 9.9% down, is 3% of the purchase price. With a conventional loan with 10% down or more, it could be up to 6% of the purchase price. But if you recall what I said earlier, if you had a $400,000 sale, 6% is $24,000. Well, an average closing at $400,000, the closing fees are about $12,000. So obviously it exceeded that amount. So you wouldn't ask for $24,000 when you only need 12. You try to make it closer to 12. Now, so that's with conventional loans. With the FHA loan, the seller concession is up to 6% of the purchase price, regardless of the down payment. With a VA loan, guys, I believe it is 4%, but I'm honestly not 100% certain without looking. I don't do a ton of VA loans in this area, so I don't want to give you the wrong information. But if you work with a minimum number of 3%, I know you're safe, but I believe it's 4% to be exact. But the most important thing, in my opinion, is when you're presenting an offer, and everybody has their strategies when they do it, is present your offer where you're including the seller concession in the contract. I know it has to be written usually in the additional provisions part of the contract, but again, you guys know best with that. And the other component to that is the house has to appraise for that higher amount. So if the house didn't appraise for 408, and let's say it only appraised for 404, well, either the seller has to reduce what they're willing to accept, or they're only going to give the buyer a $4,000 credit for closing fees. Was that clear or confusing?
I think it was pretty clear. If anyone has any questions on that, either unmute yourself, put it in the chat box, because if not, I want to move on to the next question that we had, and that was, what happens when a buyer's contingency is waived?
Which contingency, hon?
It's a great
Appraisal?
question. Yes.
All right. So from that perspective, if the appraisal contingency is waived, we're as a lender, I'm honestly trusting you guys to say, hey, we're waiving the contingency because you know the sales out there, the comps out there to say, hey, this should be okay. Definitely make the lender aware that the contingency has been waived so that they're aware that, you know, if the house doesn't appraise, it doesn't matter to the seller. But the whole idea behind the sales waiving your appraisal contingency in today's market is because it's such a competitive market, and with the highest and best and houses selling over list price, people are trying to do whatever they can to make their offer seem the most convenient, easiest offer that the seller is going to receive. From a lending perspective, just because somebody waived their appraisal contingency doesn't mean we still don't need to do an appraisal. We need to do an appraisal, okay? And I'll jump into the different types of appraisals that are done that some of you may have heard of or not, where you've heard of appraisal waivers now, where sometimes an appraisal is not done. I get this call a lot from the agents, and I should be better at saying, hey, you got a waiver. But what that means is an appraisal waiver is that when we ran the loan through the Fannie Mae underwriting system, the automated underwriting system, Fannie Mae compiled enough data in that area for that home to say, we're good with the value. We accept that value. We're okay with it. We don't need an appraisal. Recently, due to COVID, or not recently now, it's been a year, but due to COVID, we've been getting more what's referred to as desktop appraisals. I don't know if you heard that. So we get more of what's called desktop appraisals or appraisal, drive-by appraisal. So whether it's a desktop appraisal or a drive-by appraisal, a lot of times the appraisers don't even contact you guys, And again, I get the same question. Hey, I never heard from the appraiser. And I'm like, I have the report already. It's good. Don't worry about it, because the appraiser didn't go out to the home. He relied on the photos in the MLS and the comps that he saw in the MLS to appraise the home. And they were comfortable with that. And then of course you have your full appraisal where the appraiser contacts you as the listing agent or selling agent and gets into the home and measures it and walks through all the rooms and takes all the interior photos that are necessary for an appraisal.
Okay, and then the last question I have before I ask anyone if any questions came up during this call is, what are some requirements for RESPA compliance, and can that impact the qualifications to close?
So I believe this question, Christina, leads to like getting the closing disclosure out to somebody, right?
Yeah.
So the rules say through TRID that was adopted back in, I believe, 2015, that as a lender, prior to somebody closing on a loan, they're supposed to receive the closing disclosure 3 business days prior to closing. Saturday usually counts as a business day. So that's basically to review the fees, costs, down payments, everything else, to make sure the numbers are right, interest rate, the whole thing, to make sure it's right 3 days before the closing, to avoid bait and switch, so to speak, the day of closing, where years ago lenders would tell somebody the rate's 3%, and the client would go to closing and the rate was 3%, but there was $9,000 in additional fees to buy that rate down to 3%. And at that point, that buyer was kind of handcuffed because they were sitting there waiting, excited with the moving truck, ready to move into the house, and there was nothing they could do. So this has eliminated that, because the buyer's made aware of those costs 3 days, minimum of 3 days prior to the closing. If that document is sent to your buyer 3 days prior to closing, it requires their signature. So that's a big thing, that as a lender, when we send it out to somebody, when we get notified of a closing and it is within 3 days of that document going out, the buyer needs to sign it and return it. If it is outside of 7 days, then the buyer doesn't even have to acknowledge it. We did our part by I guess the old school rule is we mailed it to them and it had enough time to get to the buyer and assume that they reviewed it. But that document, that closing disclosure, that initial closing disclosure, needs to go out a minimum of 3 days prior to the closing date in order for that file to close. If it was less than 3 days, you have to push the closing out unless there is a very, very, very extenuating circumstance. And since it's been out there, I have not experienced a situation where that could be waived. But it's extenuating. It's like somebody like not doing well in their health.
Okay, so I see that we have a lot of new agents on the call, so I just wanted to ask, does anyone have any questions about what Mark has covered? Anything that you guys have regarding the mortgage process, pre-approval, anything like that? And again, if you do have any questions, just either unmute yourself or put them in the chat box.
Should, as a new agent, dealing with, let's say, a buyer, should we like do constant follow-ups with the mortgage lender that they're working with, just to make sure things are like kind of on track, on point, or do we just trust that the buyer is going to do it for themselves?
I'm going to tell you, Abel, as a realtor, you have the most money vested in a real estate transaction. You as an agent, respectfully, I say this to everybody, you make more money than any attorney, you make more money than the loan officer. You have the most to lose. So my advice to you would be, yes, you would follow up to make sure, number one, when you receive that pre-approval letter, that the individual that provided it, especially if it's somebody you don't know, did their due diligence to review the pay stubs, the W-2s, the tax returns, the income docs, the credit. And even as the process is going on, follow up, just see what's going on, make sure, you have your checks and balances. Was the appraisal completed? They have to have a commitment letter by a certain date. Did the client even apply for their mortgage? I recently had a client in January, their offer was accepted. It's somebody who I've worked with many years ago. So it's not even like we were new to each other. We worked together over the years. I did their purchase, I refinanced them, and then they sold their house and they bought another house. Their agent, who I know very well, it wasn't like there was strangers involved. Everybody knew each other very well. Calls me up like 30 days later. He goes, "How you making out with so-and-so's commitment letter?" I go, "I didn't even know their offer was accepted." because their offer got accepted. They never called me, and the agent never told me either. They never sent me the contract or anything. And we scrambled to get everything done right away, but sometimes a client doesn't apply because they don't know they're supposed to apply. They think they did the pre-approval, they're good. And in reality, they have to formalize that by officially starting the loan process to get things started. So I would tell you, always follow up and make sure your client applied, make sure the appraisal was ordered. Was there an appraisal waiver? Was there when the appraisal comes back in, especially if it's an FHA or VA loan, were any repairs necessary as part of that appraisal? Make sure they meet their contingency date. Did the attorney order title work? Did your client take care of getting home insurance? And then talk to your client about the closing date, that it's an on or about date, because believe this or not, a lot of clients see that date in the contract. And if it says March 30th, they believe they're closing on March 30th. So they may have hired a moving company to move their stuff out, to find out on March 26th, their closing wasn't scheduled because maybe the seller wasn't ready, but they were looking at the contract and just assumed, hey, everything's closing on March 30th. So I think it's very, very, very important that you stay in touch throughout the transaction, just to make sure everybody's checking all their boxes.
I have a question, Mark.
Hi, Donna.
How are you, Mark?
Okay.
So the tip to the all realtors, newer realtors watching, once you get that accepted contract, when you send it to the attorney, send it at the same time to the lender, and then follow up with a text message. Hey, I just sent you a contract for such and such. But I have a question. We recently had a very annoying experience. A week before schedule a closing date, the lender called us and said that the buyer forged some of the documents. Yes. How is it possible that they didn't know that 60 days prior? At what point, what kind of documents they checking, and how we can avoid that?
Donna, I don't know. And you and I have done a lot of stuff together over the last lot of years now. And I don't know if we've ever experienced that. I would think maybe, did they either forge documents, or was it a forgery in signature, or did they give fraudulent documents?
Apparently the guy, when they called to verify employment,
Yep.
He didn't work for a year at the place.
You got it. So they did the application, they provided paperwork. It's a loan officer's, when we start a loan, it is our responsibility to get a 2-year work history for somebody. So when we fill out the loan application, you're supposed to fill in where they've worked over the last 2 years. Maybe they said they were working there for 2 years, or the loan officer put down 2 years, or when they were asked the question, they inadvertently didn't answer it correctly because they didn't know any better. But 5 days before is tough, because we're supposed to verify that stuff prior to that point, prior to approval, to verify.
At what point you guys checking if this is really correct? Like
before approval.
Wouldn't that come up when you check for the tax transcript or something?
Well, the transcript, yes, but you don't always get a tax transcript these days. So what Don is talking about with a tax transcript is, especially when we have a self-employed borrower, we have to, one of the documents in what's called the disclosure package, the initial package from the lender to the buyer when the loan starts, is a document in there called a 4506 that gives the lender permission to verify a buyer's tax returns with the IRS, to make sure that the tax returns that they provided us as a lender match what they sent into the IRS. So when you send that document in, they get a copy of the tax returns from the IRS, you would see on there what their earnings were. And then you would see maybe their earnings were down, and question, hey, wait a minute, you said you were here for 2 years, you're making $100,000 a year, but last year you only made $10,000. Donna, to answer your question though, they should have known that prior to the loan being approved, because we're supposed to verify their work history for the last 2 years.
How we can avoid that kind of scams like before? It was my listing and my seller said I upset. She's like yelling at me how we can protect ourselves so that's not gonna happen. Like, how is it possible that 60 days and they didn't know?
I don't know. They should know. I don't have an answer for you, because you and I know we go through these things with people, and I don't know how they would find out 7 days before. I mean, you call to verify the employment, but at that point, what happens, guys, is at the end of a transaction right before closing, as a lender, we have to still call the borrower's employer. So I'll get the call, why are you calling my employer now when we're closing tomorrow? So we're just calling to make sure you're still working. It's the formality of the process.
But you're calling twice during the approval, or
Well,
just
we're double checking in the beginning, but a lot of times, Donna, when somebody gives us a pay stub and W-2, we don't necessarily call their employer, but we are matching up their W-2s from the prior 2 years to make sure they're okay and filling out the application. So I don't know exactly. I'd love to learn more about your situation, but we're verifying all that to make sure somebody has a 2-year work history. That's a requirement, having a 2-year work history. People could be working for the last 6 months and be in school. That's a 2-year work history. It could be a parent that stayed home for 2 years and is back into the workforce now, but we can prove they worked before they had children and one of the parents decided to stay home. So that would designate as a 2-year work history. But in your situation right here, it's 60 days later is way too late to find that out. They should have known that when they did the pre-approval, to be honest with you, because you're talking to the client about where they worked over the last 2 years.
right?
You
And
know.
for the approval process, what kind of documents are you guys checking?
Well, I want to see pay stubs, W-2s, tax returns if they own real estate or they're self-employed. You know, I'm almost annoying with it with people, but I don't want to run into a situation that you ran into with, and you know that because, you know, we do so much together, is I want to be thorough up front. So when they fall in love with a house, they know they can get their mortgage later. You know what I mean? It's not something came up. So guys, the pre-approval process is very, very important. And if you're working with an agent that came to you with a pre-approval, it doesn't matter if it says Big Bank USA, you should call that loan officer and make sure that they reviewed their W-2s and tax returns, because if they didn't, which a lot of the big banks don't, they just have that pre-qualification conversation, you could find out after they fell in love with a house that they can't get a mortgage. And that goes for Quicken Loans and all the other big guys out there that do the online stuff. You want to make sure that the documentation was reviewed prior to you spending countless hours in your car and gas and time with these people to learn later they don't qualify for the mortgage because nobody reviewed their pay stub or W-2.
So another question I have, sorry, but it happens a lot of like interesting scenarios lately. Arthur had the buyers and they would not like switch the lender because the financial advisor that the parents used for 30 days recommended Bank of America. They absolutely the best. We trust them with our lives. That's it. There's no talking to them or we're gonna lose them as a client. Then Bank of America sends us the pre-qualification. Nobody's gonna take the offer in today's market when there is a pre-qualification letter, not an approval letter. How we convince those people to talk to somebody else?
Here's what I would say for me. I only can speak for myself, and this is my relationship with you. And guys, Don and I, we've known each other for a long time. I'll talk to the people, and you can say to them, listen, I understand your relationship with Bank of America, but he's local. People know him. At least have him do the pre-approval. If you decide to go to Bank of America, he understands. Do I want to lose that client? Of course I don't. If I'm going to spend time with them, I want to work with them. But if you're in a situation like that, and it's going to help you sell real estate, you know, I look at the law of numbers. You're going to refer me more people. And if I have to help you get an offer accepted by giving a pre-approval letter or reviewing somebody's situation because they're willing to talk to me and let me run their credit and look at their pay stubs, even if they're still going to go to Bank of America, I would do that for you. I've been in many situations over my career where I've been asked by a listing agent like Donna, I need you to just talk to these people to make sure they're good before I accept an offer. And I talk to them, I go over things with them, make sure everything sounds right. And if I feel like it doesn't, I pass that information on. If I feel like it does, I tell them, hey, everything sounds right. They checked all the boxes. If you want me to take it further, I will, but everything seemed on the up and up with that conversation. So you can also just ask the client to have a conversation with me. And I would do that for you if you're on a listing, you know, to make sure they're good, especially in today's world.
This case, it's our buyers. So what you're saying with the pre-qualification, it's basically a conversation pretty much over the phone and they don't check anything?
Well, you want to confirm that with the institution to make sure. My experience is a pre-qualification is a conversation. They're not reviewing pay stubs. They're not They're not reviewing tax returns or W-2s. They went over everything with them and they said, hey, you're good. Maybe they ran their credit, maybe they didn't, but it's not like a pre-approval where you're being a little bit more thorough with it. At times when I have a client that's marginal, I run them through the automated underwriting system before they go out looking at a home because their credit score is a little lower, the ratios are a little tight. And as much as my experience tells me it should work, it's a computer that ultimately makes the decision. And I'm not a computer. So I have to run it through to make sure it's good. So I would, going back to what Abel's question was, and you do this already, is reach out to that person and find out what they did verify. Did they review their pay stubs? Did the client send them? And you'd be surprised how many times they don't send a pay stub or a W-2 to a lender.
So Mark, back to her issue with the buyer, I guess, falling through. Is that what I'm hearing with you? And Donna?
Yeah, the guy Abel pretty much didn't work for the last year, and we wasted 60 days waiting for his mortgage.
Got it. So, yep.
And how is it possible that they were not able to find out that before, like 5 days before the closing?
Yeah. So Mark, so what I'm hearing from you is that what you're suggesting to avoid that from happening in the future, and correct me if I'm wrong because I'm probably wrong, but is basically, whenever she as a listing agent receives an offer from a buyer, have her verify with the buyer's mortgage that they have a job or that they have W-2s or tax returns before she accepts the offer. Is that what I'm kind of surmising from everything you just said?
Abel, I would almost say that as a newer agent, you may not know all the different people out there, so it would be worthwhile to make a phone call just to make sure everything's okay. Some of the more experienced agents know more people out there. They know the mortgage people out there. They know who does a very good job and who doesn't. But I would always suggest make a phone call. I'm always impressed when an agent that doesn't know me calls me and asks me questions about the buyer. I answer it because I know it's in the best interest of that buyer. As a matter of fact, if you know that's going to happen, reach out to me and say, hey, the listing agent's going to call you. They want to know they're good. So I'm looking out for the call. I make sure I get back to them,
This is before the listing agent, or the seller accepts the offer.
I would still double check the pre-approval. If you have somebody new and they said they were pre-approved by XYZ bank, I would still just double check with that agent. Hey, I'm just introducing myself. This is the calls I get. I'm just introducing myself. I'm working with so-and-so. Just want to make sure, hey, they said they were pre-approved for this much. Is that true? I'm getting ready to show them some houses. And then we have a quick conversation. I confirm that everything is accurate and true, and they move on. And I think, again, it's a very good thing that agent took the time to reach out to me just to make sure I'm real,
Hey, Mark, how are you? Thank you for doing this.
You're welcome.
I have a question. When's the tax, if they owe tax debt, when does it show up? Like when they get the pre-approval? I missed that part.
Yeah, that's a great thing. So if somebody owes money to the IRS, is that what you're asking, Sophia?
Yes.
Yeah, that's a tough one because we don't know a lot of times until we get the 4506 back from the IRS that they have a tax lien. We can potentially pick it up when we look at their bank statements and see the debit coming out of their account that says payment to the IRS. But if they didn't tell us, we wouldn't know. And that's a good one. So when I pre-approve somebody that's self-employed, I try to find out if they paid their taxes. The red flag to me is if they didn't file their taxes or they filed their tax returns late. If they filed their tax returns late, my question is, did you pay your taxes? Did you pay your bill? Are you in a payment plan? Sometimes people volunteer the information, but you have to you get a feel for your clients if they have money in the bank, if they don't have money in the bank, because if they have money in the bank, you take the assumption they paid it because they had the money. But that's a good question. It's like a judgment. Judgments don't show up on a credit report anymore. So sometimes you don't find out somebody had a judgment until after the loan was approved. Attorney ran title work comes back and there's a judgment against the buyer. And it's a big judgment and they didn't pass it on to anybody, even though one of the questions on the mortgage application is, are you in foreclosure, default, or have judgments? Most people roll through it and don't see it. And as a lender, if their credit looks great, all in all, you don't sometimes even ask it, but another thing that comes up where you guys as realtors can learn these things, if people are talking about it, you share that information. That would be like a red flag to you if they brought up, hey, I'm in a payment plan with the IRS. Can I still buy a house? Well, yes, they could potentially still buy a house if they're in a payment plan with the IRS. However, we have to find out what that payment is, because then that's a monthly debt that we have to factor into their debt to income ratios when we qualify them. But that's information you want to share with the lender to make sure that they're aware of it. It's the same thing if you're talking to somebody who was divorced. You may want to try to find out, hey, do you pay alimony or child support? Now, I know it's a delicate question to ask somebody, but if they lead you to believe they pay it or they said it, make sure the lender knows that as well, because a buyer doesn't always think that that's a big deal, but that's a big deal. You know what I mean? If they pay alimony or child support, that's a debt that has to be considered in their qualifying. So as an agent, you don't have to ask somebody what they make a year, or you don't have to ask them if they pay alimony or child support, because you're getting a little personal at that point when they're just looking at you to sell them a house. But you can listen for things they say and then reach out to somebody like me and say, hey, they mentioned this to me. And then I can ask them that question because it deals with their finance, So, but going back to your question with the finding out about IRS tax liens, it's a hard one to find out, because if we don't have the transcript will say if they owe money. If they don't tell us, a lot of times we don't know. And if there's not a lien out there on it, we never find out because they're in a payment plan.
It happened to me. We find out 10 days before we close. So it took us because it took 7 days to get one payment clearance and another 7 days the other payment clearance. So we had to postpone the closing almost a month because it came out last minute.
Yep, and they had to enter into a payment agreement, and then you had to show they made a payment so that you can qualify for the mortgage with the payment. Exactly.
Yep. Thank you.
You're welcome.
I have another question, Mark.
Good, Donna.
Can a loan be switched from FHA to conventional without doing a second appraisal?
With NJ lenders, it can.
How about lenders?
I don't know. It's technically, I honestly don't know the answer to that, and I will get you the answer. I know what we do is we reach out to the appraiser and just say, can you change the report to conventional? And they just do it for us. But because it's the same work involved. It's actually a conventional appraisal is actually less work involved than an FHA appraisal because of what the appraiser has to look for FHA compared to conventional. But I don't know with other institutions. I just know what we do. And I've been with NJ Lenders, guys. I'm a partner here for 27 years. In my 27-year career, I've been here for 26 years. So I only know really how we do things. So I have to get back to you with that, Donna. Is that standard? So I'll reach out to one of my appraisers to say, hey, is it just as easy as changing the report for another bank, or do you have to do you have to go back out and reinspect? But
the other way around is not possible.
The other way around, if you go from conventional to FHA, they're supposed to go out and reinspect because they're looking for different things. Health and safety issues is what they're looking for.
All right. Thank you, Mark.
You're welcome.
So any other questions?
Hi, I have a question. I have a client who is looking for an investment property, and at the same time, they want to refinance their current mortgage for a lower interest rate. And they asked my opinion, should we refinance first or should we wait? And I said, I honestly don't know. I'm going to try to find out. What should I tell them? Refinance or wait?
Well, if they're refinancing for a lower rate and a lower payment, Bell, it doesn't hurt at all because they're lowering their payment. So it's not going to hurt them. It's going to benefit them because they're going to lower their overall debt. If they were looking to do a cash out refinance and take on more debt, then they should speak to their loan officer to make sure, hey, that won't affect them in purchasing the investment property. And while we're on investment properties, Christina, I want to talk about investment properties when we're done with this. So Belle, to answer your question, if they're saving money, I don't believe it could ever hurt. I'm doing a loan right now for somebody who's refinancing their house in Wayne, and they just bought themselves a second home in Long Beach Island. And they started to refinance 30 days ago, and they signed a contract on the second home. It doesn't hurt a thing. You know, they're fine, they qualify, and they're A-okay. I have people all the time when I speak to them and they're buying an investment property. One of my first questions is, if they have a mortgage, what rate are you paying on your current mortgage? And if I could save them money there, I'm going to refinance that property while they're buying an investment property, because why wouldn't I? You know what I mean? And so to answer your question, tell your client, speak to their lender. And if their lender says they can do it, all the power to them. They're saving money. Don't wait.
Actually, the lenders, you guys, they just started the process and put it on hold to be sure. NJ Lenders is their refinance company.
Who they working with here?
I honestly don't know. I
You
didn't
got it.
ask.
If you find out, I can speak to that agent for you. My agent,
Okay,
my guy.
thanks.
Just, hey, guys, real quick, what I mentioned to Christine about investment properties and second homes. So what you're gonna find out what's going on right now with Fannie Mae is Fannie Mae has had always in their guidelines, so to speak, that if a lender had more than 7% of investment properties or second homes in their loan portfolio, new loan portfolio, that Fannie Mae wasn't going to be backing those loans. And I'm giving you just a general thing. So the long story short to that is your investment property buyers, which is what we see more here as opposed to second homes in this area, the rates are going up on those because of the way Fannie Mae implemented a rule that was always in effect. They actually put it, a rule that was always written but not enforced is now being enforced. So the rates on investment properties in the last 2 weeks have jumped up to where it probably jumped up about 0.5% in price, just because the lenders out there don't know how to price out the loans because of the risk involved if you exceed the 7% rule. So they've made it very punitive right now in the pricing of those loans. So if your client says they're buying an investment property and the rate is a little higher than what they expected, it's because Fannie Mae has enforced a regulation that they had in place to lenders for the percentage of investment properties that they have. So if you have investment buyers, just beware. And then just, I guess, because we have some newer agents, Christina, I'll just talk quickly. Guys, you have loan limits. You have Fannie Mae loan limits. The Fannie Mae loan limit for a buyer to put down 3% for a first-time home buyer is $548,250. A buyer can put down 3% on a condo. They can put 3% down on a single-family home. If they are buying a two-family home as an owner-occupied property, they can put down, in some cases, 5% only, but ideally a minimum of 15% down with a conventional loan. If they have less than 15% down, they may have to go with an FHA loan, which allows you to buy with as little as 3% down on a multifamily property. Just some suggestions when you're writing up your contracts. As a lender, we look at the client's driver's license to confirm their legal name. And the simple analogy is, and I'll use husband and wife as an example, but they say they're doing the loan in the husband's name only. If the wife's name is going to be on the deed, it needs to be on the contract. So put her name on the contract. And I suggest you ask them for a copy of their driver's license and match the name on their driver's license to the contract so that the names match. In addition, just a tip is sometimes instead of saying you're going to have a mortgage commitment by, say, a certain date, put down a certain number of days, for instance, 30 days from the completion of attorney review. And I suggest that because sometimes you're in a position where attorney review goes longer than 3 days. It goes on for 2 weeks. You put in that contract that was dated today, say March 25th, that they'll have a mortgage commitment by April 25th, but attorney review doesn't conclude to April 9th. You really only left the lender 15 days to get a mortgage commitment, and maybe you're holding off on getting the appraiser in until you get out of attorney review. So just keep that in the back of your mind when you're negotiating contracts. And then just reiterating again, if a seller concession is negotiated after the home inspection is done, please, it is very important to make sure the lender knows on the transaction, because you'll avoid delays at the end. Because I cannot begin to tell you how many times I find out about a seller concession the day before the closing, because the title company put it on the CD when we're going back and forth with the numbers. And then we have to request the addendum. We have to update the file on the system. We have to let the appraiser know. That delays getting the final figures out to your buyer because there's a few steps that have to happen behind the scenes in order to release the file back to closing. But that's everything I think I have for you guys. Unless you have more questions. I think we did good, but it's up to you guys.
I think you covered a lot of information. And again, you can always pop your contact info in the chat box for people who don't have that on hand. But again, I want to be, respectful of your time. So if anyone doesn't have any more questions, we can wrap up a little early. This is recorded, so I will upload this to our Facebook page and our YouTube page as well. But for right now, if anyone doesn't have any questions, again, we can end it right here.
Thank you so much. It was very educational.
Thank you, guys.
And I also want to say thank you, Mark, for your time. I know that there were some last minute schedule changes, but we're so happy that you were able to make it. And again, we're happy that you're one of our partners. So thank you.
Yeah, and I look forward to speaking with you soon.
You got it, Abel. Any questions, don't hesitate.
Thank you so much.
All right.